For more on the markets right now, we want to bring in Jim Paulsen. He's the author of the newsletter Paulsen Perspectives and former chief investment strategist for both the Leuthold Group and Wells Capital Management. Jim, we've been watching the markets. We are sitting either at or new highs, depending on which one of the major averages you're watching. We've seen a lot of momentum to this point. How are you feeling about things?
I feel pretty good, Becky. Thanks for having me this morning. I think there's a lot of things that are going right here. We got an economy that was supposed to be dead, 18 months ago to recession from a inverted yield curve, among other things, but it just keeps going, and it's looks pretty healthy to me. Balance sheets in the economy are really healthy. Liquidity is healthy overall. So earnings, we just had another good earnings quarter, so I feel pretty good. I think the market is, or the economy is going to slow down, Becky. I think that the policies have been tightening, whether you look at higher yields than last year, stronger dollar, a lower fiscal deficit to GDP ratio, kind of modest monetary growth, traction of the Fed balance sheet. That's going to come home to roost to slow the economy and slow inflation. And so I think we're finally going to embrace the idea of a soft landing, and we're going to take inflation in CPI terms below 3%. And that could set off a lot of very positive forces for the market. So I think there's still more upside room here.
Yeah, it sounds like you think we are far more mid-cycle than late cycle, like some of the guests that we talked to.
I do, Becky, and I think that it's been difficult to judge how old this cycle is because the unemployment rate's been below 4% for 2 years. And typically, you get the unemployment rate that low, you're close to the end of the cycle. You just run out of labor. But the reality of what's going on is in the last 2 years, the unemployment rate has been understated because every month the labor force is growing. And so new entrants come in and keeping the job creation going with fresh new entrants that weren't even considered in the labor force. So I think the unemployment rate is really higher than it is being reported. The labor force is about 2% higher than the previous recovery peak level, and it's generally gone up 5% or more in almost all post-war recoveries. So I think there's still elasticity to the labor force. And if that happens, I think that we've got a ways to go before we run out of resources and the recovery is over. I think it's relatively middle-aged, not old age.
But you're not worried about inflation. You think it's going to come back down. There are a lot of things that are pushing and kind of maintaining that steady, keeping it higher. I mean, what you're describing sounds like the perfect scenario. I'm trying to think of things that would throw off that scenario or that might be more reason to give a little pause.
Well, I think that the problem, inflation has come down a lot, 9% to 3%. Wage inflation from 6 to under 4. The problem hasn't been inflation coming down. It's been coming down. The problem has been it hasn't come down to the 2% Fed target. I'm not sure where that came from, that's been declared nirvana. I don't think we have to get to 2% to have things be good. And I do think that the tightening policies that we've had in place now over the last year, including mortgage rates and the 10-year yield going from 3.5 to 4.5, that's going to slow us down. I think we're already seeing some evidence of that. I don't see how inflation from here is going to go a lot higher. I mean, could it persist, a month-end bad report here or there? Yes, but I don't think we're at a great a risk of that. And it seems like we've created this narrative of we're at such risk of inflation. I think the risk is long gone quite a while ago. And if anything, we're probably going to have more risk of it turning out much weaker than expected here over the next year, for example, rather the other way around. I'd be more about recession than I would about inflation.
And that's why you think rates have peaked here?
I do. Yeah, I look at rates. I think that if you look at the 10-year yield, it went up with the inflation rate when the inflation rate went from 0 to 9%, but that has not come back down as inflation's come from 9 to 3. It went up with commodity prices when they went up, but it has not come back down when commodity prices have come back down. If I look at the 10-year yield at 4.5%, it's now about 2% above the dividend yield on the competitive alternative of the high dividend S&P high dividend yield index in the S&P. It used to trade at a discount over much of the last 10 years. So I just think in many ways the 10-year yield to me is looking very high. I think I think we're going to have a pretty good rally in the 10-year. I wouldn't be surprised if we see, much closer to a 3% yield than 4.5%, maybe sometime before the year's out or over the next year.